Well, do you want to get started, Willie?
Yeah, sounds great. Sounds great.
So let's get started. So just want to say welcome to everybody. Thank you for listening, taking time out on a Thursday evening. I'm with Willy Gevers here, a good friend of the family and in business here. And so he is with, I'll move this over here. Can we do that? The guy here. There we go.
Yeah.
So he is with Gevers Wealth Management. And you've been in business for how many years, Willie?
Yeah, my mom named the company, by the way.
Is that it?
We've been here for 17 years.
17 years, so that's amazing. What a journey. So I myself been in real estate for 26 years. We have, so myself, April, we have Kathy Stewart who's been in our team for, I don't know, 16, 17 years, but she is the brains and the systems behind all the stuff here. There's a lot of real estate. And Amin joined us and this year. And we also have Jack McDonald, got his license and joined us just a week ago.
Fine young man too.
So we have marketing, and really the goal behind us as a team are four main focuses. If you don't know who we are, but we really focus on full service, which is really understanding the marketplace, and then we work on processing. We do a lot of work in marketing, and we also look into the whole experience. We want the experience of real estate buying and selling to be the highest level possible. So that's really our goal, and that's what we talk a lot about as a company. So jumping in here, what I want to do is, just before we start, it's always important to know, obviously we're giving information, but we want you to seek legal advice, get your CPA or attorneys to be specific if you need anything in that kind of space. So make sure you get good counsel, speak to Willie, myself, or whoever's your resource in that space before you make specific decisions. So jumping in there, what will we discuss tonight? So the reason why we're doing this, a lot of conversations came up with our clients. What's happening with taxes? What's happening with inflation? What's happening with the supply and demand of real estate?
Yeah.
A lot of extremities. There's a new administration happening. What happens within that space? So the conversation tonight is really to try and unpack that and give you insight from what Willie sees as a wealth manager and what I see as a real estate agent who does residential and small investment real estate. So that's the thought process, is to really give you some insights and optics that hopefully will help you make some decisions over the next season. So we're going to look at taxes, we're going to look at supply and demand, and we'll be finished in about 45 minutes to an hour. At the end of it, we'll have time for chat, from conversations, and if you want Q&A or even post in chat, we can answer that way there. So really jumping right in here, we have proposed changes in real estate taxes, Willie. When you look as an investor, when you make choices, you look through your line items and you have this thing called taxes, right?
Yeah.
And in the olden days, it was a figure that seemed to be, okay, that's the number, but it seems to get a lot bigger.
Yes.
Right. And all of a sudden, that's now one of the biggest line items in your strategy, right? So let's unpack that. Willie, what are you seeing happening in that space?
Yeah. Well, we have a new president, new administration. So whenever that happens, it's quite common for there to be a number of tax law changes. So there's a whole bunch of things going on that have been proposed. But what I did, I picked out 4 areas that I think might have possible impacts on the real estate market, and I'm going to walk through some strategies, some ideas, and possible solutions if those taxes pass. But I would say first that right now it's all talk.
Yeah.
My guess is, as a political observer, that most of these are going to pass in some kind of form or another. So we want to watch out for those. But what I'll talk about tonight is what they look like and what's being proposed. So there's 4 things to look at. Number 1 is a possible increase in capital gains rate. Number 2 is elimination of the step up in basis. I'll explain that in a second. Number 3 is possibly eliminating the 1031 exchange for real estate. And number 4 is reduction of the estate tax threshold. Those are all federal tax changes. So those are all being discussed. There's some serious traction in all those. Like I said, I imagine that it's a pretty good chance that most, if not all of those, will get passed in some form or another. So let me explain them first, and I'll talk about what the issues are. So number 1, right now the capital gains rate for most people is 15%. If you jump into a little higher tax bracket, which is over about 500,000 for a married filing jointly, there's an extra 5% surcharge, and there's also an extra 3.8% what's called a net investment income tax. So worst case scenario today for a high tax bracket investor is 23.8%. So again, you have a piece of property, it's subject to capital gains, you sell. It's actually not that hard to get in that bracket, because if we sell a house in Bellevue or Issaquah with a lot of gains in it, 23.8% is something that's pretty common in we see our clients hit it all the time.
Mhm.
So that's the top, that's the worst it gets. Ordinary income rates max out at about 37%. So ordinary income, in other words, the money you get from your job or exercising stock options or
Right.
other compensation gets taxed at a higher rate. So
Mhm.
real estate has a competitive advantage today. Even though you pay tax, the tax you pay is quite a bit lower than ordinary income, which is a lot of other types of income. But here's the proposal. The proposal is rates are going to increase, and they're going to increase up to maybe a maximum of about 43.4%.
Wow.
So it'll essentially double the capital gains tax rate. And that will also apply to dividends, by the way, from stocks. And so what it means is if you're a high income investor, or if you sell a very expensive piece of property, you could get spiked all the way to the top there. So that has a lot of implications. First off, again, a kind of a political observation. What some observers say is that when you see something that dramatic, maybe the Democrats, the president, are posturing, and they're giving something that's totally outrageous, and then they'll come back and do something less than that. But when they first announced it, everybody was completely shocked, including myself. So if they pass that, it's a gigantic change in that. So again, really big deal. I'll talk about some solutions in a minute. Number two is elimination of step up in basis. This is huge especially for real estate and or for residential real estate. So here's the story. I'll give you an example. Local family. Okay. I just talked to, I just had a meeting with a client that lives on Mercer Island in the water today. And they bought their house years ago. As you can imagine, Mercer Island waterfront is really expensive today. If they sold their house today, you guys all know the rules. As a husband or wife, they can shield $250,000 each of capital gains, but everything else gets taxed. But the way the world works today is if you have a piece of property and you pass away, you get what's called a step up in basis. And what that means is the property is now valued from a tax perspective at the value when the date the person died. So the kids could sell the house and not pay any capital gains taxes. So what Senator Sanders and Senator Warren have proposed, and they've got a bill called the STEP Act, which stands for Sensible Taxation, which makes me laugh. I don't know who it's sensible to, not to me. But anyway, what they propose is that if the same family on Mercer Island, if they passed away, rather than the kids getting a free ride and no taxes, they would suddenly be instantly taxed on the value of the house at the date of death.
Oh, really?
So it's a huge deal, you guys. And if it passes, it will literally be the biggest tax increase on the middle class in the history of our country. So again, a couple comments. If you read what Sanders and Warren have written in the bill is only for thresholds over $1 million. So a lot of people will think, well, gosh, maybe I'll be home free, then I don't care. But what the government has been really good at, and forgive my cynicism here, but every time a bill like this gets passed, they have a really high threshold. And then a couple years later, they lower it down and impact everybody else. And there's example after example after example of that. So I wouldn't be fooled by the $1 million threshold. That's not hard to hit in Bellevue and Issaquah. And if they lower the threshold, it could hit everybody. So again, that's the second one. Number three is 1031 exchanges. Again, I'm assuming everyone here is familiar with that, but a piece of commercial property, you can do a like-for-like exchange, defer gains. There's a serious effort to get rid of that completely. Or get rid of that up to a certain threshold. And then finally, there's a move to reduce the estate tax threshold. And I think it will certainly happen. Right now, every person can leave $11.7 million to their kids without estate tax. That will probably get lowered down to maybe $3 million a piece. So again, it's a lot of money, but if you have a nice house here and some investments, not hard to get over that level. So those are the four things. So I'm going to walk through some possible issues and how it might affect real estate. So first off, if they increase the capital gains rates, one of the things that you're probably going to see is what I call hurry up selling. In other words, wow, if they're going to raise rates, I might do that today. So I have a friend that has a mergers and acquisition company that buys companies. He's seeing an increased interest in families selling their family businesses, and they're doing it because they hope to beat the increase in capital gains tax. Our higher level technology executive clients, that's been all the conversation since the end of last year. Hey, should we sell shares earlier? Should we exercise options? Should we beat the capital gains rate? So you may see some hurry up selling. So maybe that's an opportunity if somebody wants to get rid of something quickly and sell it now. So we'll see how that affects the market, especially obviously in the higher tax brackets and in properties appreciated more. But it'll be interesting to see how that plays out. The other thing there is the way that Biden has written the law is he might make it retroactive. So it may be too late,
yeah,
but again,
interesting.
this is all being negotiated. It's not in the,
So this is proposed.
This is all proposed. Yeah.
Mhm.
So I'm curious, what do you think if a seller knew that
Right.
his tax rate was going to double? Do you think he would sell sooner? Is that the
Well,
way
that's
it
what I
works in
think.
the
That's
market?
what I love, Willie. And your insights are amazing here, because if you have a property, say it's 500,000, a condo, and I think I want to sell it in 4 years' time, and
Mhm.
let's assume the appreciation is 5%.
Yes,
So that's like 5 fours are say it's
or 150,000 or so.
150 grand.
Yeah.
So 5% per year. So I say so say 250, right? So say
Yep.
for 5 years, so $500,000 property, 5% per year compounded. So you're looking 7 to 800,000, right?
Yep.
So at the end of the day, if your capital gains is going from 23 to 40-ish, right?
Yep.
That really eats up 4 years of your gains.
Yep.
So why would I want to hold on to that?
Yeah, that's a challenge. And by the way,
Yeah.
if somebody is like, for example, works at Microsoft
Mhm.
and they're getting capital gains on selling
Right.
shares,
Mhm.
or they're an investor in some other stock and they're getting capital gains, those all get layered on top of each other. That's why I say
Right.
it may not be that hard to get over that
Right.
$1 million threshold if you have stock sales and you have capital gains from houses.
So it makes me feel as if you have to then, would that be right to say, well, you either want to really double down for a long-term play, or maybe you sell it?
Right, either long or short, that kind of makes sense.
So the middle journey, what point is it worth your while to be a property manager for 4 to 5 years?
Yeah.
Or is it, if it's 10 years, then all of a sudden it's a conversation?
That makes sense.
Yeah.
And that kind of ties into my second point.
Yeah.
If you think about how that works, so one of the questions that we get asked a lot is, hey, should I invest in stocks or real estate?
Right.
And my answer almost always is yes, you should.
Yeah.
And Steve, you've helped me buy some real estate. I love real estate investing.
Yeah.
I have a lot of real estate, and of course we manage stocks for a living for our clients. But here's the way it works in a tax point of view. Let's suppose that you have a big chunk of Microsoft. Microsoft pays a dividend every quarter, and right now most people would pay only 15% on dividends for Microsoft shares.
Mhm.
And if they're in a really high tax bracket, the dividends might be 20%.
Right.
Okay. So if they change the rules, all of a sudden those dividends, instead of being taxed at 15%, they could be taxed all the way up at 43.4%.
Mhm.
So stocks become less attractive.
Right.
The rules for real estate don't change. So the beauty of real estate is if you have a good cash flowing property, in most cases, and again, this is not tax advice, but in many cases, the depreciation and your expenses shield the income. So you could be in the highest tax bracket and own a duplex or an apartment building or a triplex, and the rental income is basically essentially tax free.
Right.
So if you have two assets, real estate and stocks, and all of a sudden the tax bracket on the stock gains gets way higher, it's going to make real estate look even so much better. So again, I'm curious to see what you think, Steve, but I look at that as a favor for real estate. It makes it less bad from a tax point of view.
So the exchange principle to me, going back to hurry up and sell, or even attempt out on exchange, that to me is such a pivotal moment, because for a young family, they buy a house, they buy a rental property, and all of a sudden you start to build wealth, one house to, you're rolling your money from up, and all of a sudden they buy an apartment building, right?
Yep.
So that really stops that pathway to success.
Yep.
Would that be right?
Yeah, that'd be true. So whenever you change tax policy, you change behavior. So that could be one thing. The third option, I'm going to hit really briefly, but in the TJC Act of 2017, the Trump Tax Act, they created something called opportunity zones.
Right.
And opportunity zones still offer tax deferral. So I think they're going to be relatively more attractive. That window's only open for about 3 or 4 more years. But if somebody was looking to, let's say somebody came to you, Steve, and said, listen, I got a really a property with a lot of gains in it, I want to sell it. What you could do is you could say, sell the property, and you might suggest to me, look for an opportunity zone investment to reposition your assets into, to get both tax deferral and help there. So again, if they make tax worse everywhere else, the opportunity zone might be a way to encourage the seller to say, hey, there is a way to sell and mitigate at least some of the taxes.
Right.
A fourth area is the use of a self-directed IRA or self-directed Roth IRA to buy properties. So this is a complicated area. Again, if you guys watching, if you're interested in this, please don't go right out and do it. You need to get some advice on this, but you can use your IRA account to buy investment properties. You can't use it to buy the house you live in,
Right.
but you can use it to buy investment properties. My wife and I have a couple of investments in our IRA accounts, real estate investments, and I know a lot of other people, some of our clients have done it too. So the disadvantage of an IRA account, of owning real estate in an IRA account, is that all the tax benefits of real estate don't flow through to you, like depreciation.
Right.
But if they make taxes higher on real estate, it'll be relatively more attractive to buy an investment property in your IRA account.
Right.
So let's suppose you have a 401k and you've got $1 million in there, and you say, gosh, the stock market, worries me. I want to use it for real estate. You could set up a self-directed IRA. You could roll some 401k money or IRA money to the self-directed IRA. And if you're very careful and you know what you're doing, you can buy, invested real estate in there. Again, Steve is the guy who can help you with that. It's very, you want a self-directed IRA specialist and something like that. But that's one of those tools that, it has been used a lot. It's been very popular. But I think it'll probably be more popular if this tax bill passes, because again, when you change tax policy, you change behavior, and this may be a way to do it. So again, for you folks watching, if you have a lot of money in your IRA accounts and you want to buy an investment property, something to think about. That'd be a way to look at it. And then the final thought there is, there are a number of vehicles. One of them that really sticks out is something called a charitable remainder trust. So there are legitimate, completely tax code approved, IRS approved vehicles that allow you to sell real estate and basically pay no capital gains tax.
Right.
So it's a whole subject in and of itself. I teach a 2-hour class just on the subject, so I can't walk down that rabbit hole. But you might put this on your list if that fits your, as something you want to follow up on. Talk to Steve or talk to someone like me or talk to your, whoever you're working with. And there are some trust planning vehicles that allow you to sell and avoid capital gains tax. So bottom line, if capital gains goes up, you could increase. Or it could change behavior, but there are ways to try to mitigate, to avoid, to do things differently to try to change that. So we'll see how that plays out.
That's excellent. Anything else on that slide you want to cover?
Yeah, I'll hit that. I don't want to run over time here, but let me hit the other three there. So the next change is the I wonder if our participants can see it, Steve. Can we drag that bar up out of the way? The slide number 2. Be careful when it's upside down. The second thing that's going is a step up in basis. So again, let me explain how that works. The step up in basis means that when you pass away, you no longer get to give the money to, or give the house to your kids tax free. So again, kind of picture is you buy a house in Bellevue and Newport Hills or in Clyde Hill or Medina, in the 70s, and you bought it for a pittance, and today it's worth $2 or $3 or $4 million. Well, if you pass away, it gets revalued and you avoid capital gains tax. So a lot of older families don't sell their house for just that reason, because the thought is, and this is valid tax planning, hey, you know what? I'm just going to keep the house. I'm going to hold on to it. If I just wait till I pass away, my kids will get it essentially tax free. Well, they want to eliminate that. And again, Senator Warren and Senator Sanders are really working on that. And again, it'll be interesting to see what that means. But one thing I thought is maybe that gives incentive for older families to sell now, because if they sell while they're living, they each get $500,000 free. Right. Do you see my point?
Yeah.
So for older families, this is a really big deal. The step up in basis is very meaningful, and many people that I've talked to have said, hey, I'm not going to sell because my waterfront home, my expensive Bellevue home, it's just, I pay too much taxes. And if I just wait, my kids will get it, capital gains tax free. So I'm curious what you think, Steve. Do you think older people will sell sooner if they no longer have the benefit of giving out their kids tax free?
Well, there's big numbers. I think definitely. I think the benefit of residential real estate is that you're shielding for that 250,000 per person.
Yes.
So for that to go away, or that's the conversation, right?
Now, the 250 is not supposed to go away. The step up in basis.
So for the step up to go away, that in place. So no, I think this is a really, they're family discussions, I think, that we have to lean into. Yeah. Sometimes they're tough discussions, as you know. Yeah. Talking about passing, mom and dad passing, but it's a lot of money. So I think it's definitely worth.
It is. Yeah. And the story gets worse too. Here's the rest of the issue. The way that the bill is structured, the legislators, the word they use is called deemed death. In other words, what they're saying is when mom and dad pass away, it becomes taxable. So in other words, you can't get around this by not selling the house.
Right.
You have to pay the tax on it. And so here's the story. Let me give you a real life example. They already do this in Canada. This has been around for a long time. So we have a client we work with, and their mom passed away, and she had a very, very expensive waterfront house in Vancouver Island.
Right. Mm-hmm.
And she passed away, and the tax was due basically almost immediately, and they couldn't quite get things ready to sell the house that quickly. Plus, it was a couple of years ago before the real estate market was so hot, so they had troubles with that. So there's some liquidity issues. You may have to borrow money. You may have to, ask the IRS for extensions. So here's the story as a real estate buyer. If they pass this rule, and you're an opportunistic buyer, maybe a seller would say, gosh, I need to sell this house before my tax bill is due. Maybe I'll sell it for a little bit less because I know I need to pay it. So there's going to be a liquidity issue for the kids or the estate. And it's important for us, both as sellers and buyers, to understand that. If I'm an adult child and my parents have an expensive house, I need to be thinking about that. If I got a big tax bill due, if my parents pass away, it's not the first thing I'm going to be thinking about, obviously, but all of a sudden, before you know it, the IRS is going to have their hand out.
Right.
And then if you're a buyer, maybe there's an opportunity to help somebody out by doing a quick sale there. So who knows how that'll play out? Maybe that will depress prices. I don't really know, but again, tax policy tends to change behavior, and this is a really very, very significant passage. So we'll see how that plays out.
Wow, that's amazing. And then the reduced estate threshold. What's your thoughts on that?
Yeah, let me kind of hit 1031s for just a minute.
Totally.
Yeah. So number 3 is 1031. So again, I'm assuming everybody knows what that means. You have a duplex, an apartment, an industrial building. You can do a like-for-like exchange, and you can defer taxes. And again, there's a very serious effort to eliminate that. And so if that happens, it's just like what you said, Steve. It might slow down or discourage sales of investment properties.
Right.
Again, there's a little solution. Like, for example, what we do for our clients is we do a lot of tax loss harvesting with our non-IRA accounts. So let me give you a real life example. One of a family we work with has a very, very expensive farm in the Midwest.
Right.
And they were getting ready to sell it. And they also have a very large investment account with us. So we started doing almost weekly tax loss harvesting. In other words, in their stocks, if we had a dip down, we would tax loss harvest. And don't get the wrong idea. If we do that in the fee count, there's no commissions on transaction costs.
Yeah.
But every time there's a dip, we harvest losses. They ended up selling the farm on a contract. So we have capital gains every year.
Right.
So every year we try to realize losses. As you can imagine, last year with coronavirus, the markets went way down and went way back up again. Last year we harvested enough losses to basically almost eliminate all their capital gain from the contract for the sale for the year. So if you're going to sell an investment property and there's no longer 1031, you'll want to work with your investment broker to, be really, really proactive on tax loss harvesting, because the way the rules work, if you have a loss that you harvest in a stock or a bond or a mutual fund, you can offset gains in your real estate that way. So there's a creative way to do that. Again, it's free. It doesn't cost anything. It's on an advisory basis, something you can do. So I'm thinking this will be a really powerful strategy for our clients if it happens. So we're really keen on that. I hope they don't get rid of the 1031, but if they do, we're all going to have to be more creative and proactive, you guys, on tax planning.
No kidding.
Yeah, and then finally, the state tax threshold. There's again, it's like the step up in base. There's a liquidity event. The estate tax is due in 9 months.
Right.
So if you've got an expensive property and you can't sell it right away, you still have to pay the bill in 9 months unless you get an extension. Again, in the kind of market we have right now, you can sell a property just like that, especially if you work with the McDonald Group, who are really, really good and can get you the highest price in the quickest amount of time. But again, I'm not really clear on how the estate tax threshold will affect real estate, but I think the liquidity is one thing that both buyers and sellers might be aware of.
Right.
In other words, expensive property, you've got to pay the tax in 9 months, and if you don't make plans to sell it, you've got to figure out how you're going to pay that tax bill.
So when you look at this, Willie, what I'm seeing is there's a lot of proposal, a lot of conversations, which can be really retroactive, right?
Yes.
So you're in this really in a tough position.
Yes, very much so.
Because it's not like there's a little 5%, 3%. This is like could be 20, 22%.
Yes.
So what advice? How do you lead into that? What do you recommend? Because as a strategy, should they be talking to a wealth manager, their CPA, their attorneys, and really estate planning?
Yeah, all of the above.
All of that,
Good advice is always a good idea. I think the one thing that I've seen, and this is true on real estate, it's true for businesses, and it's true for technology executives with a lot of shares, is if they were planning to sell anyway, if the thought was, hey, I'm going to start selling some shares in the relatively near future, again, it might be the hurry up selling, like I talked about. You might do it now and at least sell some of your properties to lock the capital gains in, because we just don't know where gains will be in the future. This is a little bit of a weird way to look at it, but you might think of it, taxes are on sale now. Taxes are lower now than they might be in the future. So if you can pay your tax bill now at a lower cost, it's like buying something on sale. So I think the one key action you might want to take today is say, if I'm going to plan to sell soon anyway, then maybe I do it sooner rather than later. I called Steve in April and Ahmed and Jack and talking about doing that. But the rest of the things, gosh, I mentioned some possible solutions, and we just need to be really aware of what's happening, because there are major, massive tax changes going on, and they're going to affect all of us pretty dramatically.
No, that's good advice. So they're really going forward. I think if you're looking to sell, you want to lean into that.
Yes.
And then staying in communication. No, that's really good. And so this is a lot, Willie. You've just dumped a whole bunch of great information on us here. And so Treasury, what's going on here?
Yeah, let me talk about the. So I'll change gears a little bit. Steve, you asked me to talk about the economy, so I want to talk about the big things that are happening. So there's kind of three things I'm going to pick out. I know economics are kind of dry, so we're going to make it kind of fun and lighthearted. But the three things we want to look at are interest rates, money printing, and inflation. And I also want to introduce Tina to you. And Tina is probably the most powerful real estate person in the market, right? Even more than you guys. So I'll talk about Tina, but here's the story very quickly. Interest rates, of course, are at levels we've never seen before. So I'm not exaggerating this, you guys. Interest rates are at 4,000-year lows. There are some economists that went back and calculated what interest rates were all the way back to the, before the U.S. it was existed, and the Babylonians, the Sumerians, and the Israelites, and literally rates have never been this low in the history of the world. Here's what I translate to. This is from yesterday. If you wanted to buy a 12-month treasury bond, you would get the grand total of 0.07% interest. So again, let me kind of make that clear if you're not good with numbers, you'll make more interest digging around in the floorboards of your cars for pennies and nickels than you will in a 12-month treasury bond. And even if you got 10 years, the interest rate's 1.34%. So there's a lot of applications that, you guys. One of them, of course, is mortgages. We all know that the mortgage rates are low and it makes it better to buy. But from an investment point of view, if interest rates are that low, there's not that much attraction. If I told my clients, hey, let's put a bunch of your money and lock it up for 10 years at 1%, that's not really going to create a lot of excitement. So what that does, it moves money to other assets. So what are the other major assets? Well, the two biggest asset classes in the US besides bonds are stocks and real estate. So if you want one of the explanations why real estate prices are going up, there's inventory too, which we'll talk about. But this is part of the financial story. And this number has been quite low since last April. And the Fed came out even today and said, hey, we think it'll be low until 2023, 2024 or longer. So that's a really big issue, the interest rates. But it gets worse than that, you guys. Rates, have been low, but in the previous years, they've gotten way lower now. But if you go to the next slide, the other thing that's changed is the rate of inflation has dramatically changed. So what I'm showing you there is the rate of inflation going back just in the last 12 months. And to give you a historical context, inflation has been hovering between 1% and 2% pretty much for most of the last 20 years. And if you had money in the bank, if you had a CD last year, you might have been earning 1.5 or 2% money markets until a year ago, or money 1.5 or 2%. So inflation is at 1.5. Interest rates are at 1.5. If somebody has a bunch of cash, they can kind of tread water there and not get hurt. But today, think about the world for a minute. Remember the rates I just showed you a minute ago? Rates are essentially zero. And if you can see the top of that graph, inflation right now is 5.4%. That's the annualized rate going back 12 months. So if you're an investor, or if you're sitting on cash, your cash is disappearing at 5% per year. That's really significant. And you'll notice from the graph that it's getting worse every month. And so it might be even worse than you're seeing here. So there's a lot of arguments there. Some people say inflation is transitory. Some people say it's supply chain. Other people say, no, it's here to stay, but we're printing so much money. My personal opinion, and you can check me out in a year or two to see if I'm right or wrong, but my personal opinion is the money printing, the environment we're living in is conducive to higher inflation, and we're gonna have more inflation. So again, let's make a personal application. The two things that we're talking to about our clients the most, the questions that get asked me in the last 6 months is, how do I buy another house? Which is why I love passing people on to you. And number two, what do I do with my cash? I've got 50,000, I've got 100,000, I've got $1 million in cash. Inflation's 5, I'm earning 0. Ouch, I need to do something. So again, if you want another explanation why real estate prices are going up, all of a sudden it looks pretty darn good to buy more real estate.
Right.
Because you just can't earn any, not only are you not earning any interest, you're losing value in the bank account. So this is very powerful, you guys. This is called a negative real rate. And this doesn't happen very often. In fact, it's very rare. But when you have negative real rates, in other words, when your rate of return is actually negative because inflation is worse than interest rates, that's a powerful lever to move money out of cash into real estate. And rental real estate, perfect recipient for this type of scenario.
Wow, that's amazing, Willie.
The third big issue is money printing, and the graph you're seeing here again looks a little confusing and pretty busy, but it's a screenshot from the Federal Reserve. So if you're geeky like me, I watch this all the time, and the Federal Reserve prints their balance sheet and what they call the monetary base, so you can see what is happening out there. So if you're not aware of this, you'll want to look at this. But here's the story. If you go back to 1960 and you look at my graph there, or look at the Fed's graph, you'll notice that the line slowly rises above the page. In other words, the rate of money creation in our country was relatively slow. And if you look at the little flag I put there, January 2008, the year the financial crisis started, the total money supply in our country was about $800 billion, billion with a V. So the Federal Reserve was created in 1913. It took about 100 years to create $800 billion worth of money. So right now, you guys, the money supply in our country is getting close to $7 trillion. So we've increased our money supply about eightfold since 2008. I mean, the money supply has gone up like a skyrocket. It's gone incredibly high. Right now, I just checked the numbers last night. Right now, the Federal Reserve is printing or creating about $150 billion a month. So let that sink in for a minute. At the end of 2008, or beginning of 2008, the total money supply was $800 billion. Right now, we're printing $150 billion a month. So every 5 months, we're printing about as much money as created in the entire country just a few years ago. Staggering. It's just mind blowing. And again, you can see it on the graph there. So what does that mean to us as investors? When you create that much money, it has to go somewhere. And I'm laughing a little bit. Anand, you're on the call with this, and a mutual friend that you and I both know, I won't name him, but when he got his stimulus check, I asked him, we were all out for dinner together. I said, hey, what are you going to do with your stimulus check? And he said, I'm not an idiot. I'm going to go buy Bitcoin. Okay. So that's really kind of captures where we're at, you guys. When that money gets printed, when it comes in, people are not keeping it in the bank. They're buying stocks, they're buying real estate, and they're doing stuff like Bitcoin too. So again, if you want another explanation why real estate prices are going up, you've got financial inflation in the sense you've got massive amounts of money, and that money is flowing into real estate. So one more thought there. I wrote about MMT I've had there, so that, you can Google that later. But the question you might ask, are we going to keep doing this? I think the answer is a resounding yes. The economic theory that's really taken hold of in the government is something called modern monetary theory, or MMT. If you Google it, you can find lots of articles about it. But let me summarize it in one or two sentences. What MMT says is the government can print as much money as they want, whatever they want, to promote growth, and it's not a problem. So 10 years ago, in 2008, we were like, oh, we can't print much money. We're kind of scared about it. But now, a lot of the Democratic senators, a lot of our Treasury secretaries, the Federal Reserve, they've really adopted MMT. So what that means to us is probably expect more money printing. And what that also means is that money might flow into real estate. So that leads us to Tina. So if I was kind of joking about Tina being more powerful than Steve and April. So Tina is not a real person. Tina is an acronym, and Tina stands for There Is No Alternative. Tina, there is no alternative. Okay, so you have $7 trillion of cash sloshing around our system. It doesn't want to go in bonds because bonds are paying 1%. It doesn't want to go to the bank because the banks are paying 0. So what are all alternatives? It's real estate and stocks, and to a much lesser degree, it's gold and Bitcoin. So the big story in the investment world right now is Tina. And you know, again, if you Google that, you'll find lots of Wall Street analysts commenting on that. And again, that's probably the biggest driver, at least on the financial side, for real estate prices.
That's amazing, Willie. So you just dropped like 5 hours of knowledge into like 20 minutes. So we're trying to absorb it. So what the way I see it, let me just say back what you're saying.
Yeah.
If you're playing Monopoly and there's 50 houses,
Yeah.
right? And there's still 50 houses, but we keep giving all the players extra money.
Perfect example.
There's still 50 houses.
Yep.
Right.
Yep.
So that's the tension. You see all this money I love the way you say sloshing around, but it's looking for somewhere to go.
Yep.
Right. And there's still only 50 houses.
Exactly. Yeah, that's perfect. And I think when you talk about inventory, that's the other side of the equation, right?
Totally. So you have this tension. You wonder, why is that tension coming in? It's because there's money trying to seek somewhere to land, and there's nowhere to go.
Yep.
No, that's really good.
Yeah.
So let me shift gear. We've got about 20 minutes left, guys. Thank you for letting us just give you that insight. We're going to do more practical into some supply and demand and some local things that are happening. I'll give you some insights, and Willie and I will kind of ping back and forth. But before you do that, I wanted just to show you what we'd like to do is kind of talk about anything else you need. We're full service. Willie and I want to be trusted advisors. If you're looking at design trends, valuing, remodeling, and selling, all the things that we release date and stock. If you like that, please post it in chat, or April will also send out an email. But we want to get information of what do you need, and if we can help it, we have lots of resources that we can get to you. So please put that in there. Take a few seconds. That'd be awesome. So jumping in here, I want to talk a little bit about this tension. So how do we monitor? How do we lean in and say, okay, Willie, all this money's coming in,
yes,
right? And there's all this houses, but how do we monitor that? How do we get ahead? What's the number? So the way we do it is we really look at supply and demand. And we look at that as months supply. So a visual we talk a lot about in our office, the whole idea, because you're a fisherman, Willie, is a fish pond, right? The fish pond, there's 100 fish in a fish pond. And if I can go in 1 month, I can capture 20 fish. Right? That means there's 20 fish I can take in 1 month. I could fish for 5 months. So I have 5 months supply. So how it works in our world is if I say, take this a neighborhood and there's 100 houses on the market and 20 sell, I have 5 months supply of houses. The next question is, how many houses are coming on the market? Right? Yes. That's the new listings or the new fish in the fish pond. And if I'm fishing and I catch a fish in a rod, that's pending sales. Right? So the way we look at this kind of story is, how do we really look at supply and demand? This month's supply of fish or really houses, right? So that's kind of what I'm going to go into the next 4 or 5 minutes is, what do we have and what do we see naturally and where's it going to go to? And then once we know these numbers, have a context to it, we can start to make decisions as to how to really equip ourselves and our investors and yourself and your strategies, okay? So let's look at so what's kind of normal here? We're looking at a buyer's market and a seller's market. So a neutral market typically is 6 to 7 months. Now, in this last crazy few years, for all this money coming in, really a neutral market might even be 3 to 5 months, okay? So let's assume that. So a buyer's market would be anything above that. So a seller's market today, if we look there, we're looking in the 1.5 month supply of homes nationally. So we not only are we just below neutral, we're way offline into the seller's market. So the tension is beyond something that, even if things stopped and got changed tomorrow morning, how would that physically change? So think of ourselves here. We have a seller's market. There's so many buyers, there's not enough houses. Wow. This is just a tension that we see across the board. Okay. So let's drill into go from macro to micro. So nationally, 1.5 month supply. Now we look at this graph, which really indicates and shows us King County. When I look at this, Willie, I try to look at year over year. So the holiday season a little different. The summer season, the sun comes out in Seattle. All the realtors go on the boat for a month, right? And then they come back, they're trying to sell some houses. So what we're looking at here is year over year. So if we look on this graph right here, over this line here, we're looking at the dark line right there would be your houses that are sold, and this is what's for sale. The red line indicates your pending sales, and the blue line is your listings. Okay, so the good news is that we're actually seeing more listings coming on, and the pending sales are dropping down. This is in King County. So we're coming from a very extreme market, right? But the reality is that we're coming from an extreme market, but there is more houses coming as we go into the summer season. Okay, so just to give you a visual on that there, well, there's actually 22% more listings than there was last year this time. So that's good news. The pending sales are actually up 16% from last year, but what's for sale is actually 39% less. So when they go into the whole fish pond analysis, there's 100 houses of fish for sale or fishing, whereas now only 60.
Wow.
And the solds are up 35%. So what it means is there's basically 40% less. There's only 60 fish there, but there's 40% more activity. Wow. So your sellability here is really, really tense. So that really comes down to locally in King County, we're looking at 0.5 months supply. Wow. So we're looking at 3 to 4 months is healthy, 1.5 nationally. Then you drill into our area at 0.5 months supply. So houses are selling an average of 7 to 10 days, and it should be really typically in this time of year running about 31 days.
Has it ever been that low before?
Never. I've never seen it.
Ever?
I haven't gone back 4,000 years, Willie, but I went back about 40 years. I've never seen it this tense, right? So if we look at that, so let's go drill into like an area here in Magnolia. So I'm going to pick out a Seattle neighborhood, and I'm also going to pick out a East Side neighborhood to give an idea. So this shows us here. I'm going to go back one slide. So this shows us the area right over here. This is Magnolia right here. Okay, so we can see this graph coming up. So Seattle's slowing down, and I see personally there's more opportunities. Okay, and then so if we go into the east side, this is 98006. They're right here. We're looking right here. The crazy thing is on the east side, what like I've never seen before, Willie, as well, is we have the tech world, right? So we have Amazon, Microsoft. We all know the biotech here. But what we have is every house that's coming on over here, right there, is getting sold. So let's put that into context, right? We have 22% more houses coming on the market, right? Then we have the pending sales are up 70% from last year, okay? And their actual inventory levels are down 60%. So there's 100 fish last year. We're down to 40 fish, but activity's up 70%.
Those fish are getting caught pretty quickly.
It's like insanity. So you are seeing numbers that I've never seen before. Aggression like I've never seen before. So you're 0.4 months supply. Wow. And historically, like you talked about inflation, if it was a 1%, 1 month supply, typically that would indicate like our one month supply would typically indicate 1% appreciation per month, which is 12% per year. We're at 0.4% in the east side right now.
So does that imply 24% per year?
Yeah, so exactly. You're in the 20%. And that would be that. So in Seattle, we're actually seeing a little bit of a slowdown and out and then peripheral, which is nice. It's not so we're coming from a very, very tense environment. So it's a little really a reprieve, I think would be. So let me jump in and look at some conversations that are coming out nationally. I think you'll find encouraging actually. So if we look at monthly showing index, so what is that? So all the realtors go in and make appointments to show houses, Willie, right? So they go into a thing called showing time, and we can tell in showing time who's looking and what's happening. Oh, so the good news is we're actually seeing a little bit of a reprieve from last year or from last month. So if you look over here, it's actually slowing down the last 3 months. So it's slowed down in buyer activity. Now last year we see here that was an indicator 166, which was really busy. We're at 248, but the trend is actually slowing down slightly. Okay, so that's kind of good news if you're a buyer. Very tense, right? But the good news is there's slightly more homes coming on, and there's less people looking. Okay. So let me just look at a little bit as an investor, how do we look at the realities of buyer fatigue? So record price appreciation, sometimes up to 20%, extremely low inventory, record high percent sales over list price. Now we're actually seeing that drop in the last 3 weeks. So before we had 20 offers, and now we're actually seeing 3 or 4 offers. Wow. So the intensity of the people behind the offers is actually softening. Yeah. So a really good insight. Buyer fatigue. Buyer fatigue. Yeah. So it's a very strong word here. Record days in market from 31 days down to 7. And historically low interest rates. So the good news is I think we're seeing the interest rates are actually going to start to actually increase slightly, which we think will temper some of these conversations, right? So buyer talk, what we're seeing in the marketplace is we're seeing a slight slowdown, okay? The market is still hyper competitive, but summertime is really the time. If you're a buyer, I would say this is your time. I don't see long-term this thing going with all the money keep coming in. Yeah. But right now we're seeing this maybe 2-3 month window where we see slightly more homes than normal. So that's good, right? Yeah. It's not great news, but it's better than it was 2 or 3 months ago, all right? So if we jump in here, we're looking at the senior economist or realtor. He's saying the improvement we saw in new home listings growing from May to June shows sellers are entering the market historically later in the season. So what that means is because of COVID, I think, Willie, it's hard to say. People who typically list in February, March, April are actually now listing in the summer. I think the vaccine's coming through, people, the less strangers in your home. So we're seeing slightly more homes coming in, and we're also seeing a slight increase in activity listings and in the interest rates going up as well. So there's kind of a combination here. Let me jump in here. I'm just jumping through here. But we're seeing across the board, people are saying there's a supply is increasing slightly.
Okay? Is it increasing because they're building new homes, or increasing because there's more listings? More
listings are coming on, and the buyer fatigue. So buyer fatigue, and we look at interest rates here. We're proposing, or people are telling us, Freddie Mac, Fannie Mae, the MBA, National Associated Realtors, everybody's saying the interest rates are going up slightly.
So going back to your monopoly board example, if the inventory is growing because of more listings, not because more houses are being built, it's still the same story. You've got 50 houses and a bunch of money chasing it. So
money's chasing it, but money's slightly more expensive. Now there is a buyer fatigue, and that's why I brought this up, is I think if you're an investor, you're looking at buying, you're going through 5 or 6 months of tension, there is now opportunities beginning to come through. So that's kind of, to me, that's good news. A few more of these. So talking points, sellers were actually noticing, a house is worth 1.2 million. Let's put it on the market for 1.5. It's not selling, weirdly enough. If you put it on for 1.25, it will sell for 1.5. Yeah, it's interesting. There's a lot of strategy right now. I would really encourage you to get to your local real estate people, and I'd get people like Willie to get what's a strategy. But if you go too high, it's where the market really speaks. But if you go in aggressively, it drives up.
Yeah,
and it seems to be a common theme.
And by the way, what I tell our clients that are selling, I say, go talk to Steve in April, because you may think there's a lot of money out there, but a good realtor who knows how to negotiate. I mean, the story you shared with me about the house on the lake is unbelievable. So the skill that Steve and April have at setting up the bidding and negotiating and putting in backup offers is really quite remarkable. So
there's a lot in that, Willie. To me,
it's almost like that could be a great subject for an entire seminar.
Negotiation strategy. I can't tell you, I have to charge extra for that one. But no, really, there's a lot in that world which I think that people have to be aware of. So forecast for housing here. We've got maybe 10 minutes left. The forecast for housing appreciation will begin, they say, to return to historical norms. That's the home price expectation survey.
And that's nationwide.
That's a national number. I think, to me personally, what I'm seeing is the numbers are a lot bigger than that. So you take nationally, you walk into the Northwest and then go to Bellevue in Seattle, these numbers would be a lot higher than that. Okay, so if you look at, say, for 2025, your national appreciation over the last 30, 40 years is about 3.8% for real estate. So we're saying it's going to slow down. So that's a very interesting number we'll see there. And then jumping into an area that people talk a lot about, is there a bubble, right? And so the only thing I could see to speak to that space is there are a lot of people panic bought at the start of the year. Let's buy in, Chelan, let's buy in Idaho. Their second homes or investment properties, and they're really spread out there. But there's if you want to look at the work from home policies in the big companies locally, I think that's going to dictate what's going to happen. So if they say, Microsoft or Amazon say, hey, we need you back in town, right? That's going to cause a little bit of a tension on a pendulum, which you don't know what's going to happen. So what's they going to dictate that nationally is what's the work from home policies by these large companies.
And Microsoft is calling people back, and so is Amazon. So
So if that happens, there will be some type of, so is there a bubble in some of these areas in Boise? I don't know that, but that's the only area I would say.
Chelan went crazy last year.
Crazy. So that would be an unknown to me, but locally, I'd be pretty comfortable seeing there's definitely a lot of growth ahead of us there. So just to wrap up on that here, if we go to this final couple of slides here, the forecast for housing is very positive, right? And here we see some people are saying 8% for the year.
Is that for 2021?
2021, yeah. And the last thing I want to look at, if you have a house here that's worth, we have on our screen, we can't see all the details here, but if you have a house and you buy a condo for $350,000 and there's an 8% return per year, what we're seeing is over the 8% return with these growth here, you're looking at $93,000 equity. So if you look nationally, the equity that's happened over the last 6 months or the last year, people are feeling very, very strong. So I think the last 2 months, people like $43 billion was pulled out of houses. So not only is money coming in, equity going up, and people are pulling equity out, and people are really very comfortable.
Yep.
And another number is that 38% of the homes in America are owned free and clear.
Really, that many?
38% is the number that came out a couple
I
of
didn't
weeks
know
ago.
that.
So just crude numbers. So money's coming in, there's a lot of equity, peel that out as well. So overall, there's this liquid situation happening, and it's all going towards real estate from what I can see.
Yeah. And I would interject there too. What I did for my kids, and I'm teaching a class at church on personal finance. I would take that slide that Steve had, and I would say, when you get more equity on your condo, pull it out, go see Steve, buy a second property and rent your first one, and just keep that real estate thing growing. So there's a great strategy there to increase your wealth and increase your income by buying more real estate.
So just to wrap up from that side, I'd love Willie to get into a little bit of strategy here, because what we can see is the monopoly board's a good picture, right? Where there's a fixed kind of assets, money's coming in, inflation's a big conversation. That really, even hyperinflation, I don't know what word you put on that, but there's definitely seems that, how do we deal with that?
Yeah. Well, I put 3 strategies up here for real estate owners. And by the way, just kind of our background, we're a wealth management firm. We have a fee-only platform. We have a world-class platform for managing investments on a fee basis using institutional managers. But we also advise in real estate. And because I was a commercial real estate for a few years, and because I'm a real estate investor, I'm really interested. I love working with you on that. So, for example, this week we had a meeting with someone who's looking at buying a big storage, RV storage location. And earlier this week, we talked to a real estate developer who's putting together a multifamily investment property that some of our clients may want to be in. So I'm pretty actively involved in that. So when we work with people, there's really kind of 3 things on the real estate. Number one is what we call the Henry planning. Henry stands for high income, not rich yet. And a lot of folks we work with are mid-career. They're making really high incomes, but they have no plan for creating long-term income. So there's a number of strategies there, but one of the strategies in our toolbox is real estate. And Steve, you and I have worked on that before, and we've done some classes on that before, and we'll help people position their real estate investments to create future wealth, future income for the future. Because you don't want to be a Henry your whole life. You want to be high income and turn that high income into future income. So we do that too. One of the things that I suggest people, just kind of a rule of thumb, I have the 30% rule. The great thing about real estate is it's a great wealth builder, but we also know that things go through cycles, and there's going to be downturns. So we also do some testing, and we if somebody has real estate, we say, okay, let's make sure that the next time there's a downturn, you're able to hold on until things get worse. And I call it the 30% rule. So we do pressure testing, I guess, for lack of a better word, to make sure that we're not doing something that's foolish or that we can't hang on to. And then finally, one of the big questions, for all of this is we're going through what looks like a great reset right now. And you're seeing that in taxes, you're seeing that in politics, you're seeing that in social things. There's very possibly more changes happening now economically and tax-wise than we've ever seen before. So part of what I like doing is helping our clients with strategies to think about that, to be proactive. I'm a little bit geeky, but I love reading tax journals and economic journals. So we spend a lot of time and energy on that and say, okay, what if we have a real estate portfolio? What if we have an investment portfolio? We're still working with other business. What can we do to protect ourselves? What can we do to be in a position to try to best go through any kind of market turmoil or market change? So those are kind of some of the ways that we help real estate owners with their planning and their wealth management.
That's amazing, Willie. No, definitely, I think when you see the high income, not rich yet, I love that kind of concept here.
Yeah.
So any thoughts on why real estate? Because for me, I people who know me, I love real estate, and I go on my vacation to look at real estate, and I take pictures of real estate, and my kids, like, really, Dad, but it's something. I'm in this world of real estate, but I think when I talk to you, Willie, you're stepping back and looking at things contextually. Over the lifespan of a person, and then over their different assets and how to be strategic. So you look at as a wealth manager leaning into real estate. What's your thoughts on that?
Yeah, well, let me give you a quick example. So Microsoft executive, very, very wealthy, 8-figure net worth. But in Microsoft, there's no pension. He's too young for Social Security, and who knows if it'll even be there in a few years. And so his only capital is his stock, his Microsoft stock and his other investments. And we know from last year and from 2018, 2015, and 2018 that we have downturns. And so to build all your income off stocks is not wise. And I'm saying that as investment manager, I think you should have multiple sources of income.
Mhm.
So what we did for him is we said we helped him position a pretty good chunk of his portfolio,
Right.
and we've taken it out of our investment portfolio. We've moved it to real estate. So he owns rental houses now. He owns.
Right.
He's invested in multifamily. He's looking at some other things too. So we've got another source of income. And the hope and the belief is if we have a stock market downturn, we can still collect income from his real estate as an alternative source of income. So
Right.
it's prudent to be diversified. King Solomon said, divide your lot into 7 or 8 pieces because you don't know what kind of misfortune will fall upon the earth. So as investors, we just want to make sure that we've created a financial life where we have multiple streams of income.
Right.
And real estate fits in beautifully for that. So we don't manage real estate directly, but I love giving our clients advice on it. I love having them go to you and getting help on that. And I feel really good for our wealthy investors if they have a chunk of real estate as a diversification strategy for the conventional investments that we're helping them with.
What about like from an inflation perspective? What are you seeing there? I think obviously assets are important.
Yeah, we're talking a lot about inflation with our clients, and my favorite real estate hedge, my favorite hedge for inflation is multifamily.
Right.
And multifamily leases are typically 12 months. In other words, every 12 months the lease turns over, and a duplex or a triplex or even an apartment. And so the owner of the property has the ability to fairly quickly increase rents to offset inflation. So when you have inflation, if you have assets that have good pricing power, quick pricing power, then that's very advantageous. Airbnbs are even better. So if you have a property that you're Airbnbing, well, you can change your rates tomorrow if you want to.
Yeah.
So Airbnbs, I think, in a higher inflationary environment might get even more attractive because they're kind of built that way. So if someone's looking at a house with you and Airbnb is something they want to consider, I think the higher inflation goes, that could potentially be a nice thing to have as part of your portfolio.
No, that's good. Really well. Actually, we're out of time here, guys. It's 8 o'clock. Do you want to just wrap up here? Any final thoughts, Willie?
Yeah, I just put out a list of some of the ways we help people that have real estate. So if anybody wants help, feel free to call us. If you like what I talked about, like I said, I'm a real economic geek. We have a regular newsletter we wrote. You can sign up for our newsletter list. Our last newsletter, I try to make it fun. Our last newsletter is titled, What Do Scuba Diving, Bitcoin, and Gold Have in Common? So if you're interested, sign up and we'll send you a copy of that and hopefully enjoy that. But
that's so funny.
Yeah, we'd love to open up to any questions
you're not gonna answer that question. You gotta go there.
Send us an email. We'll send you a copy of the newsletter. You can see it for yourself.
That's good. So do you want to open up a couple of? We got maybe 1 minute left, guys. Do you want to open up for any questions?
Yeah, and by the way, I'm okay for longer. So if we want to stay past 8 for questions, we're happy to.
We can do that.
So I see some questions on the chat there.
What about blockchain?
What about blockchain? That's blockchain is a technology that cryptocurrencies are built on, especially Bitcoin. So remember when I talked about TINA? TINA means there is no alternative. I wrote it. If you get my newsletter, I wrote about it in some detail. But my personal opinion is Bitcoin would not be as popular as it was if it wasn't for all the money printing. So Bitcoin is kind of seen as a alternative store of value or alternative currency. And if we weren't potentially ruining our dollar and diluting our dollar by printing so much money, I'm not sure Bitcoin would have ever taken off. But because we're printing all this money, Bitcoin is seen as a valid alternative to the dollar. Blockchain is the technology that Bitcoin is built on. So there's a great deal of controversy on Bitcoin. Some people say it's going to zero. Some people say it's going to $1 million. I don't know. I tell our clients, maybe if you like it, just put a little teeny sliver of your portfolio there. But blockchain is a whole different story, and that's a tech issue. And what you're seeing is the major credit card companies, real estate. Blockchain is a way of transferring assets or transferring information, transferring contracts. And blockchain is going to be a major disruptive technology. And blockchain is not Bitcoin, by the way.
Yeah.
So looking for companies that are putting blockchain into as part of their operating system, I think is a pretty interesting thing to look at for the future.
That's good. So a question there, Willie. This is a powerful thing.
Yeah, the whole beanstalk thing. That's way out of the real estate world. You know, we like to really focus on investment fundamentals. We're you know, a big we love dividend paying stocks. We like stocks that are fairly valued. We index a lot of our portfolios. We're looking for very low cost institutional managers. We don't do any meme stocks in our portfolios. So I've watched it. I read Wall Street Bets for fun sometimes. You know, what's the joke? Stocks always go up, right? So, but professionally speaking, I'm not touching that. So if someone wants to have some fun, you know, maybe take a little bit of money and explore there. But for people that are working with us, have their serious money there, the money they need for the rest of their life. So we treat that very seriously, and it may be a fun adventure on the side, but for our, you know, for our portfolios, the process we're following is very serious. And by the way, real estate's a great part of that. You know, again, a good blue chip, solid, you know, wonderful, diversified part of a long-term investment plan.
That's good. Well, guys, let's wrap up here. I just want to thank you for your time. Thanks for having us just a chat. Willie, really appreciate the information. And I think we're opening up this whole world of tax discussions, real estate, all this money coming in. It's really an exciting time. It's actually quite a exhilarating time to be alive. So I want to say thanks for joining us, Willie. Any parting comments?
No, I appreciate you being here. And you know, if you have any more questions, I know that you know, Steve loves to help people, and I like to help people too. So feel free to ping us on an email. I'm happy to help anyone we can. And I would just say, as one of Steve's professional referrals, and also as a personal client, if you work with him, you're dealing with a really wonderful man, a great human being, and a really, really good real estate agent. So I would suggest him and recommend him with absolutely 100% confidence. So
that's mutual, Willie. I appreciate it. No, actually, what Willie helped us many years ago. We brought into Compass. I was running that, and you were the first guy to come in and really help navigate us through a lot of the transition. So I appreciate your wisdom and your reading and your knowledge. So thanks, Willie.
My pleasure.
Thanks, guys. Thanks for your time. Have a good night, and we'll see you real soon. Thanks so much. Thank you.
Good night, everyone.
Okay, bye-bye.